All right, good morning, good morning, good morning. Lovely Monday to all of you. And we are going to start a fairly robust tax conversation today. Before we do, just administrative, of course, as always, please invite all your friends to our forum. We're now at 1,700 members. We're getting tentatively close to 2,000 members, which is pretty exciting. Looking forward to that day. Okay, today's presentation is going to be on taxation. And the first thing I'm going to mention is that we have gone ahead in the past and dealt with new build and assignment taxation at some length. So if any of you are interested in new build taxation, assignments, HST or the like, on this very forum, and you can look it up by tag. We have given video sessions and I have written extensive articles about how to calculate. If anyone has those questions, available for everyone. What we're going to talk about today is going to be the resale and commercial taxation considerations that real estate agents face on a daily basis. And to that end, I'm going to share my screen with you fine folks. Let's see, I'll share, hold on a minute. Let me see if I can pull this up. Hold on a minute, let me get the right thing up. There we go, okay, let me share it. There we go. Can someone just confirm for me that they see what it is that I am sharing? Okay, good stuff. Glad to hear. All right, so let's go into this. Some of this will be stuff you know, some of it will not. The reason that I am saying that definitively is because every one of us deals with tax every single day of our lives. And because I'm trying to give a robust overview of tax, undoubtedly, we will have to go over some areas that you know, some areas you do not. So let's begin with the fun. First, let's deal with land transfer tax. So land transfer tax, how it's calculated is probably not all that important to you. And the reason it's not that important to you is because most of you simply type in land transfer tax calculator online and boom, it pops out. What you should know, however, is that land transfer tax is calculated on a gradual basis. If you're in Toronto, of course, there's an extra land transfer tax. And it works something like this. And you'll recall this from the numerous OREA courses that you've taken in the past. On the $0 to $55,000, you pay $275. Between $250,000 and $55,000, you pay $1,950. And I'm going very quickly through this simply because I know you guys are all familiar with what a graduated amount is. You may not know or remember what the actual numbers are, but never once when you're trying to calculate land transfer tax are you going to go to this lovely slide that I prepared for you, other than to understand conceptually how this works. And of course, what I would point out to you here, which you may not be familiar with, particularly if you are in the residential space, is that there is a distinct, first of all, Toronto and Ontario's land transfer tax calculations have, as of the end of 2017, largely been brought into line with one another, meaning that there was a distinction in the way that you used to calculate it. It is no longer as apparent. There's still minute distinctions, but not much, as you'll see in these charts. But the other thing I would mention to you is that there is a distinction as between a duplex or less or a triplex or more. There are different taxes. Generally, it is more expensive from a tax perspective, from a land transfer tax perspective, to be acquiring a duplex or less in both Toronto and Ontario. But the way you would do this out is a simple calculation similar to what I have on the right-hand side. Again, I'm going very quickly through the slide because I know from experience and having seen people use this stuff that literally absolutely no one will use this. They will simply type in land transfer tax calculator and use it. I just want you to kind of understand the way that this actually works. All right, let's get to the meat of land transfer tax, the stuff that you guys actually do care about. So land transfer tax does not always have to get paid on every single transaction. And Section 2.1 of the Ontario Land Transfer Tax Act, which, by the way, is mimicked by the Metro Toronto Tax Act, applies to all transfers of land except transfers with no consideration. So, unlike every other tax that is payable, capital gains, income tax, or anything else, in the Income Tax Act, there's something called imputed value. Imputed value means that two parties can set any value they want for a transaction. But if you are trying to avoid tax by setting a lower amount, you cannot do so because the CRA has the unique ability to impute the actual market value, and thus you will be defeated in putting down, say, $0 and therefore trying not to pay capital gains, or putting down a fictitious amount. Let's say you purchased a property for $100,000 and 10 years later you sell it for $100,000. You cannot avoid capital gains that way because putting down $100,000 will be subject to challenge by the CRA, and they'll impute the true value of the property, meaning they'll have to pay the capital gains in any event. This is not true of land transfer tax. Land transfer tax allows you to put down $0 if you actually have not paid consideration. And so if I were to transfer land to you for $0, yes, I would have to pay capital gains on it, but I would not, if it's a true gift, I would not have to pay land transfer tax. This is not true, however, if there is an existing mortgage of the property. If there is a mortgage, if I transfer to my son, say a property worth $500,000 with a $250,000 mortgage, then what I am actually transferring can only be, from the perspective of land transfer tax, $250,000. It cannot be zero, even though I'm making no money on it. That's the rule. And so you can transfer for no consideration, but at a bare minimum, the consideration amount for land transfer tax will be any existing outstanding mortgage on property. Not the registered amount, the actual amount that is outstanding. Sorry guys, someone has reverberation. Can I just ask whoever, I think maybe it's, here, hold on, I'm just muting a couple of you. I'm sorry. Okay. All right, let's move on. So there's also no tax if you're transferring between affiliated companies. Now, affiliated is a defined term in the Income Tax Act. For the perspective of understanding this and subject to certain qualifications, and there are qualifications, affiliated companies are, say, things where you own more than 50% of the outstanding shares and have effective control of the company. Transfer between spouses and former spouses, even for money, is something which I shouldn't say even with money. I'm sorry. Let's keep this simple. Transfer between spouses and former spouses, if no consideration is paid, would be not subject to land transfer tax, or if it's done in accordance with the written separation agreement, which, by the way, has consideration values, right? Because if I'm getting the house, then it's offset by perhaps some other payment elsewhere. But as long as there's a signed separation agreement where the parties have agreed to live separately, so it's not just a married couple that feels that they're smart and puts together a separation agreement, but someone who actually agrees to live apart separately, there's no land transfer on the transfer of that interest in land to the other spouse. And then last, a transfer between individuals and family business corporations are also not subject to land transfer tax. I'm often asked, can I put my assets into a personally held corporation? The truth is that there is something in the Income Tax Act called butterfly, which allows you to basically roll your assets into a personally held corporation for no tax consequence. And you can similarly do that for a land transfer tax. Having said that, I would note that it doesn't work the other way. You cannot unroll from a corporation into an individual, nor would a corporation selling to an individual be subject to a land transfer tax exemption. So there are tax consequences when you move the other way. I'm just pointing that out. Okay. The other thing
that— question, Mark.
Yeah.
In the previous slide with spouses, if, for example, if there's only one spouse on a property deed, God forbid if something happens that they die or something, and that has to be transferred to the others, would that still be exempted?
Would that be exempt from land transfer tax?
Yeah.
Yes, it would.
Okay.
Yeah. You don't need to have both parties on deed in order to transfer. If you're transferring between spouses, and this is a truism in tax as well, where there's a transfer as between spouses on death or anything else, and probate, and God knows what, all of these things are largely, I'm not saying in every case, but largely exempt. There is an exemption on transferring to spouses, which, by the way, brings up a famous case, because it's very similar in the States, where someone decided to marry their daughter for the purposes of taxation, and the courts found that to be an invalid marriage for any number of reasons. They thought they were very smart doing it this way because they were going to transfer all their assets on death. Anyways, I digress. Land transfer tax. Let's talk about first-time homebuyer exemptions. So first-time homebuyers in Toronto and Ontario can qualify for an exemption for a maximum, if you're in Toronto, of $8,475. That being $4,000 in Ontario and $4,475 in Toronto. To qualify for that exemption, you have to be a Canadian citizen or permanent resident of Canada. You have to be 18 years or over. You have to live in the home within 9 months of purchasing it. It cannot be an investment property. It cannot be an investment property. In fact, one of the questions that a lawyer will ask you at the time of closing is this property something where you or your spouse will ordinarily reside within 9 months? You have to swear that. And most importantly, you cannot have owned an eligible home before. And if you have a spouse, they cannot have owned a home during the time they've been your spouse. Now, this causes the most confusion, and this is probably the stuff that starts becoming a bit new to the seasoned agents who are currently on this talk. Let's talk about both of those things. Firstly, what is an eligible home? So if I've owned an eligible home before, I cannot qualify for the land transfer tax. What's an eligible home? Well, anything that you normally consider an eligible home is an eligible home, right? Like a detached, a semi-detached, a townhome, a condo, a mobile home, a duplex, a triplex, a fourplex, or shares in a co-op. But what it doesn't include is vacant land. It doesn't include large-scale multi-residential. It doesn't include commercial properties. It doesn't include office, meaning that you can go ahead and properly invest in real estate assets that are properly commercial in every sense of the word and still qualify for the land transfer tax first-time homebuyer exemption, because you will not have owned an eligible home. You will have had a property before, that is true, but not an eligible home under the definition. Let's talk about spouse. So it's constantly the case that people are approaching me and saying, all right, well, my spouse has owned a property before I got married. Well, in order to understand what the consequence is, you need to understand the rules. And the rule says that the spouse cannot have owned a home during the time they have been your spouse. So what's a spouse? Well, a spouse under the Family Law Act, there's two definitions of spouse. One is a married spouse, and the other is a spouse. Married spouse means married spouse. It means that you got married, there was a priest or someone else, you officiated, you registered as married, there you go. But that's not the definition of spouse that the land transfer tax authorities use in order to determine whether or not the person who is deemed to be a spouse owned a home at the time that they were your spouse. In fact, the definition of spouse is that found in section 29, which is the non-married version of spouse. And it includes either people who are married to one another or people who have cohabitated for a period of not less than 3 years, or people who are in a relationship of permanence, meaning that they have a child. If any of those things are true, then that person is your spouse. And if that spouse has owned property at the time that they have been your spouse, then you do not qualify for land transfer tax exemption. Does that make sense? I'm going to pause here for a minute before I move on. That is what there is to know about land transfer tax as best as I can determine from my experience doing this. Anything anyone wants to add before I move on from land transfer tax? No, we're clear? Okay. Let's now move on to municipal taxation. So how does one determine what municipal taxation is? Well, if you're a normal agent, you say, well, I know what municipal taxation is. The seller provides it to me. It's part of my MLS listing. It's right up there on my sheet. But that is a very silly way of actually determining things, because you're relying on a third party who is hearing it from another party, the seller, to post on MLS. And oftentimes it's wrong. But there's a very easy way of actually determining what the mill rate is. every one of you has access to public records. Public records is MPAC. MPAC stands for the Municipal Property Assessment Corporation. And what the Municipal Property Assessment Corporation's job is to take every PIN in Ontario and review them every 4 years. Every 4 years, every single asset in Ontario is assessed by the government and given a value. Usually a value that's a bit less than what the market will bear, but it is the assessed value, the value that the government of Ontario is providing to the property. That value is critical because that value is then multiplied by what is called the mill rate. The mill rate is what is produced by the cities, every municipal jurisdiction every single year. And so in this instance, you'll see that I picked Toronto's mill rate from 2019. And you'll see that on a residential property, the total tax, the city rate is 0.45, the education rate, the city building fund, yada, yada, yada. You add all these things up, you get the total tax rate, which is the mill rate on a residential. What does that mean? Well, that means that if the Municipal Property Assessment Corporation, the document that says public records on your MLS database, if you go and type in a property and it tells you that in 2019, the value of the property is $592,194, right, which I just made up. I don't know why I picked that figure, but it seems good to me. Then all you need to do is take this and multiply it by that, and you have the taxes that are due and owing per year. So this times this equals this per year. And then you can just divide it out into monthly payments to figure out what the monthlies are, but you can also verify the assessed value. If someone puts something on MLS that just looks hideously wrong, instead of calling them up and saying, hey, this looks hideously wrong, are you sure about that? Screw that. Find the assessed value by looking it up on public records, multiply it by the mill rate, which you can easily type into Google and say Toronto mill rate, Mississauga mill rate, whatever it is, do the multiplication and then call them and say, look, I've done my own math. You're off. You're clearly off. Go do your work and get back to me with the real amount or show me a tax bill. And it's just a good functional way of dealing with the liabilities that exist for the sellers and the buyers agents in ensuring that all information posted is correct, which is an obligation that everyone has to the best of their ability. Okay. First of all, does anyone have any questions about municipal taxation, MPAC, or the mill rate? I know I'm going fast, but there's a lot of taxation issues that I want to get to today. Can everyone hear me? Everyone's clear? Okay, good stuff. Glad to hear. Let's move on. I appreciate people who are typing in. Is there any resource that can confirm the Toronto area? So Dennis is asking, is there any resource that can confirm the Toronto area? So Dennis, I'm assuming what you're asking is there any resource that we have that confirms the Toronto mill rate? Is that what you're asking? Am I correct in that question, Dennis? That you're asking, is there any resource that can confirm the Toronto mill rate?
What, can you hear me?
Yes, I can.
Okay, so what I'm asking is, I know Woodbridge, let's say, doesn't fall under the double tax rules.
Yeah.
So is there like a map or something that we can confirm? I know Etobicoke does. So like, how do we differentiate what does and what doesn't get double tax?
Oh, you're saying for the purposes of land transfer tax?
You got it. Yeah.
Very easy way of doing it. If you want to figure out if it's doubled or not, did that area vote for John Tory or not? Because anyone who voted for John Tory is in the Toronto area. So all the boroughs that were amalgamated by Mike Harris in 2000 into the city of Toronto, all of them get double taxation. Anyone outside of that, meaning if you voted for Mayor Crombie, if you voted for Hazel McCallion before that or whatever else, none of that is applicable. It's only the people who voted for John Tory in the last election or had the option to vote for John Tory. Does that help you?
Absolutely. That's perfect. Thanks.
Okay, very good.
I have a question.
Yeah.
So where do special levies show up? Because they're not going to be on the, like the geo warehouse assessment or MPAC, right?
Do you mind if I just address what a special levy is before I answer that question?
That would be great.
Great. I'm sorry, who asked the question?
Tracy.
Hey, Tracy.
Hi.
What many of you may not know is that as you drive down different neighborhoods, you may see various improvements. Sometimes you may see like a street that's made out of brick. Other times you'll see street lights that are really nice. Neighborhoods have the option of paying additional taxation dollars to beautify their neighborhood. And oftentimes that can levy special taxes in the area. Where does that actually factor into the mill rate? Well, it's not. It's actually added to the tax bill as a special levy. And there's no way to actually determine if a special levy exists in an area absent two specific ways. Either you can request a tax bill, or you can speak to the town planner of a given area, which none of you are going to do. You're just going to assess the tax bill. But if you actually go into the city of Toronto or any of the municipalities between 8:30 and 9 o'clock on a normal day where COVID is not raging, the building inspectors, before they start their day, have a half an hour to answer questions about the particularities of given issues or given areas. And if you are purchasing a property and you have any specific questions regarding zoning or potential building or taxation and special levies, you can speak to them. I mean, Barry Brooks knew me very well because every single day I was going in and asking him questions because I was developing an area at one point. He was a town planner. And that is the way you would figure that out, or you would acquire a tax bill. It is not available through the mill rate or the taxation sites, as far as I know. Did I answer your question, Tracy?
Yes, you did. Thank you.
Okay, let's move on to income tax. Look, guys, everyone pays income tax, but not everyone really quite understands how it works. And I find that one of the things that agents would most benefit from, and one of the things that I spend a lot of time doing, is explaining exactly how a graduated system of tax works. Because it's all well and good to turn to a client and say, yes, tax is payable, and then you have to pay income tax. But if you don't understand what the absolute dollar figure is that someone is likely to pay, it's very hard to have an in-depth conversation with them as to what the actual consequence of sale or purchase or return on investment is. And so I'm just going to go over something which I'm sure you're familiar with, but I just want to be very quick in kind of the way taxes work. The way taxes work in this country is, and I'm going to stick only with this column right now, the income column. If someone goes ahead and works for a corporation, say they work for Yorkdale or Oxford, if they are deriving $0 to $42,960, of that $42,960, let's say that that's what they earn, they will take home 80% of that. 20% of it goes to tax. That's not entirely true. There's additional deductions, but conceptually, 20% goes to income tax. 80% goes to them. If they earn $46,000, then the first 42 of that 46, they pay 20% tax. Then the difference between 42 and 46, that being the $3,000 or whatever it may be, they pay 24%. This is tedious for most people, but actually has huge ramifications. As an example, and I must say, I do belong to one of the two political parties, so please take what I have to say with a grain of salt. I'm not trying to be political here, but I am just going to mention the idea that one of the things that the Liberal government did over the course of the past 15 or 20 years is they raised this number significantly. This number, when Dalton Ginty took office and when Harper was in power and Dalton Ginty was in power, that number was about 43%. That number is now 53%. And people who look at that say, oh my God, we're paying more taxes. And indeed, those people who make more than $220,000 a year are definitely paying more taxes. But what's missed, because this is a detail-oriented discussion, is that these numbers and these numbers were significantly raised in the course of raising this number. So what the government decided to do was they said, okay, we are going to actually, instead of having this number be $36,000, we're going to make this number $42,000, meaning that everyone who makes $42,000 will pay less tax because this is the way graduated tax works. Because before you used to pay 20% tax on only 36%, but now you're paying 20% tax on 42%. Where's that extra money coming from? Well, it's coming from very rich people. Anyone who earns over $220,000, though P.S. that's not that rich in Toronto, given what prices of real estate are, but still, what they're doing is they're trying to make it more graduated, or what they have tried to do is they tried to make it more graduated by futzing with these numbers here and making sure that more and more people qualified for lower and lower rates of tax until they hit the top earning potentials, at which point these numbers went through the roof. Now, don't get me wrong. This is a very political discussion, income tax. And the truth is, so is capital gains. I mean, the decision to actually tax capital at half the amount of income has direct consequence on those people who have done nothing but inherit money as opposed to work for it. This is all a political discussion, but you should understand how that political discussion at least works. And when someone says, yes, taxes have been raised to 54%, the answer is no, they haven't necessarily been raised to 54%. They've been raised to 54% if you are sitting there earning over $1 million a year or over $220,000 a year. Whereas if you earn less than it, it may actually be a beneficial discussion. Again, I'm not trying to take a side here. I'm just trying to explain what the discussion points are as people kind of go through this. So the 2018 marginal tax rates were these tax rates. And honestly, they're not that much different in 2019, which was our most recent reporting tax year. Income tax is different than capital gains. I've told this story before on this forum, but very quickly, income tax, sorry, someone is asking a question. Allow me to, is it true they're bringing capital gains on, they're bringing in capital gains on principal residence? Asked Dennis. Dennis, with your permission, I'm going to answer that when I get to capital gains. Let me just first explain the difference between income tax and capital gains. Income tax is paid on the income that you make. Capital gains is paid when you sell the asset that makes you income. There's a whole bunch of assets that we have in this world that make us income. From the perspective of real estate agents, most notably, that is income properties. So generally, if you hold on to an income property for 10 years, the income tax would be paid on the rent, because that's what you are doing. And when you sell the actual unit itself, that becomes a capital gain. And again, capital gain is taxed at half of the amount of income tax. And so, if we take a look at how a capital gains calculation, so income tax is just paid on the amount you get from your employer, right? Hypothetically, or from rent or anything else. There really doesn't need to be any sort of discussion on this point. If I get $100,000 from my employer, then I pay 20% on this amount, 24% on this amount, 29% on this amount, 31% on this amount, 33% on this amount, 37% on this amount, and 43% on the balance between $93,000 and $100,000. And that's what you end up paying to the government through your weekly pay deductions every single week. Capital gains is a bit different. Capital gains basically works the following way. And I know most of you know this. I'm just going over it quickly because I want you to understand tax, and it's going to factor into some of the more complex areas that we're about to get to. If your original purchase price is $400,000, if the sale of your property is $500,000, the profit, assuming that you have no other deduction, is $100,000. Your capital gains payable is 50% of that profit, and assuming that the seller is in the highest tax bracket, 54%, right, like this amount here, so they've earned over $220,000 a year from their, say, normal employment, then they have to pay that $50,000, so half of a $100,000 gain is paid at 54%. They have to pay $27,000 to the government. So it's hugely advantageous for something to be classified as capital gain as opposed to income. And I've actually gone into this in great detail just a couple of video sessions ago. If any of you want my great example of Chudley's apple farm and the Christmas tree farm, please go look it up. I went into it in some detail. I don't really want to go into that here because I have a feeling most of you are aware of it. What I would, however, tell you is that capital gains is not paid. There are two great things that the Canadian government offers Canadians where you get off scot-free, tax-free. One is on the sale of your principal residence, and no, to my mind, there is no desire that anyone has by any political party, except for maybe the NDP, which has floated it from time to time, but they are far from power, to have capital gains on a principal residence. So no, there is no knowledge that I have that that is changing. And what that means is that if you and your spouse, you're allowed to designate one primary residence. Note, this is not the same thing as a matrimonial home, completely different things. You have one primary residence that is exempt from tax in a given tax year. And what that means is that any increase in value in that home is not subject to capital gains when you sell. That is one of the huge benefits that you get. The other huge advantage you get is an $850,000 lifetime capital gains exemption on CCPC shares. What that means is that if you own a private corporation in Canada for more than 2 years and you sell that corporation for over $850,000 in profit, you will effectively have that amount of money capital gains free as well. That is a once in a lifetime opportunity, as opposed to your primary residence, which is a once in a year opportunity, meaning that you are entitled to have one property in your asset class, not accrue capital gains in a given year. Does that make sense? Does everyone understand what I've just said? Because we're about to get a bit more complex now. We're going to move into the areas that you are. I've kind of gone pretty quickly through this first half hour. The next half hour is going to be the stuff that you guys may not know about. And we're going to get a bit more complex based on what it is we've just talked about. Sorry, just one second. Sweetie, I'm just in the middle of a presentation. Sorry, guys, just one second, please. I do apologize, guys. Okay. So let's move on. Let's get a bit more complex. Okay, you guys probably remember this. Let's talk about this. When you go ahead and purchase a property, you are allowed to depreciate that property. And I'll talk to you about why this is important now. When you go ahead and someone is going to one day turn to you and they're going to say, hey guys, I have some great news. I have someone who has a pool of capital with $30 million in it. They absolutely want to sell, they absolutely want to buy something. You're going to feel on fire. You're going to be like, wow, $30 million, that's phenomenal. Oh my God, I'm going to be able to retire off this commission. But what the person with that money is not telling you is that they're going around to every agent in the city saying, hey, if you have any multi-res properties, I'm ready to buy that multi-res property, because multi-res property is incredibly valuable. And because sellers don't want to sell multi-res. Why don't sellers want to sell multi-res? Well, firstly, there's the capital gains that they're going to take on. We've talked about that already. Secondly, what the hell else are you going to do with the money? You're going to take the money and then you're going to need to place it somewhere. There's no better asset than multi-res. Why not just keep it in there? But third, there is depreciation and specifically recapture. We're going to talk about both those things now. So let's say that you purchase a property for $1 million. At that time, your accountant will allocate a value to the land and a value to the building. That's what they will do. That's part of the accountant's job. They'll say, okay, the building value is X and the land value is Y. The insurance company will do that as well. There are professionals that assist in this. So in this instance, I'm going to say that on $1 million purchase, the value of the property is $800,000 and the value of the land is $200,000. That's how it allocates. Now, every single year, this property produces $60,000 worth of revenue. What does that mean? Well, that means that if this building is held in a person's name, the $60,000 is, as we've discussed, income tax. And that $60,000 would, if that $60,000 is added to their normal salary of $220,000, would be taxed at 54%. That's a lot of money. That means that every single year you're going to have to pay $32,000 over to the government. Now, don't get me wrong. Most people try to throw in a whole bunch of expenses. But let's say that after expenses, they had earned $60,000. So they had tried to reduce their tax hit as much as they could. They earned $80,000 a year, but after $20,000 worth of expenses, the income from the building, the NOI, became $60,000. Well, $60,000 means that they have to pay $32,000 of that to the government. No one likes paying that to the government. Good news, the government gives you a bit of a break. The government says, okay, we understand that everything in this world depreciates. Not land. Land doesn't depreciate. So we're not going to depreciate that. But the building itself definitely depreciates. And the building value, as we said, is $800,000. So every single year, the government puts out what's called a CCA depreciation schedule. And the CCA depreciation schedule says that these are the rates that something can be accounted for depreciating every single year. So if you're a computer, as an example, it depreciates over the course of 3 years or 5 years or whatever it may be. If you're an automobile, it's 5 years or 7 years. I don't remember what the CCA depreciation schedules for it are. But the idea is that every single year you can say it is worth this much less. Land is worth 4% less. Sorry, buildings are worth 4% less every single year. This isn't true of the first year. There's something called the half-year rule. I'm not going to get into it. Just conceptually, I don't care. I just want you to understand conceptually what's going on. But after the first year, it depreciates by 4% every single year. So what does that mean? Well, that means that I am able to take 4% of this $800,000, which, as it turns out, means $32,000. And I can say, thank you very much. I'm going to subtract this $32,000 from the $60,000. And now my taxable income becomes $28,000. So instead of having to pay 54% of $60,000, I'm now able to pay 54% of $28,000. That's the way depreciation works. And the next year, my building value will be $768,000 because I will have depreciated it by 4%. And I can take that and multiply it by 4%, meaning that I can then depreciate $30,000 as against my $60,000, meaning that my taxable income becomes $29,000. And so on and so forth until the building is fully depreciated. So why is it that the person who approached you with $30 million that made you so excited, why is it that you're not actually going to be able to help them place that $30 million? Well, again, as we discussed, capital gains. 2, what the hell else are you going to do with the money? And 3, because every person has been forced to take CCA depreciation. Let's say you've owned a multi-res property for 30 years. So every single year, you have lowered your NOI, your revenues, to whatever it is you can using your expenses, but there's still been taxes to pay. And as a result, every single year, you've turned to your accountant and say, please depreciate, use my depreciation on my value of my building. But that depreciation is assuming that your depreciation was correct. When you resell your property, lo and behold, the building value will not have depreciated. It will have actually gone up, because that's what happens with real estate. And when that happens, all of this depreciated amount, let's say that it's been 5 years, all of this amount that you have depreciated over the course of years will be deemed to have been done improperly. And that is the beautiful tax called recapture. So if your building value has gone up and not down, then the accounting metrics, which you were allowed to do over the course of those 5 years that you've owned this particular building, now needs to be reconciled with reality. And the reality is that the building is worth more, not less. And thus, all of the depreciation that you took suddenly comes due in that tax year. And as a result, not only do you have to pay capital gains, not only do you, what the hell else are you going to do with the money once you get it, but you're also going to have to pay the recapture, the savings of tax that you've had. And so the longer you're holding on to one of these buildings, the less likely you are to sell it, because the greater the tax hit through capital gains than through recapture because of the CCA depreciation that you took. Does that make sense? Does everyone understand what recapture is? Anyone have any specific questions about it? Make sense? Okay. Let's turn, now that we understand capital gains, now that we understand recapture and depreciation, let's turn our attention to another, it's not really a tax, it's a fee, but it might as well be called a tax, and it's called probate. Let's turn our attention to probate. So probate is the tax, again, it shouldn't be tax, I'm going to change that to fee. There's a technical difference, actually. Probate is the fee we pay on assets we own on debt that pass to non-spousal beneficiaries. So you remember how I said at the very beginning that if you're transferring as between spouses for capital gains purposes, for income tax purposes, for anything, usually it's exempt. And it's largely the same for probate. And the probate calculation is actually pretty simple. It's not like the land transfer tax complicated calculation. On the first 0.5% of your estate assets up to $50,000, for the first $275, you are basically, $250, sorry, you're paying 0.5%. That's what it is. And anything over $50,000, you pay 1.5%. So as the example I've given here, if someone dies owning a home, the tax on the property, the tax on a property valued at $1 million is $50,000 times 0.5, so $250, plus $950,000 times 1.5%, being $14,250. And so you add those two up, on $1 million home, the probate fee will be $15,000. So people understand the reason that this is a fee and not a tax is because a fee can be avoided. A tax cannot be avoided. That's what the case law says. You can plan, but you can't avoid. But you can avoid probate through all sorts of tricks. It's a fee. And one of the tricks that everyone asks, and they will ask you, and they ask me every single day, is this. My dad has passed, leaving a property to mom who's in good health. So dad just died, mom continues to exist. Should the kids, or in this case, one child, let's say that there's only one child, add themselves as a joint tenant to the property to avoid probate? So let's think about this. Kid knows that when mom dies, that asset will then require probate, a will that is going to be probated. And when that happens, let's assume that the value of the property is $1 million, $14,500 is about to go to the government, right? We just talked about it. It's highlighted on the screen. Is there a way to avoid the $14,500? Aha, says the kid. I think if I just put myself as a joint tenant with my spouse, with my mom on the property, then when mom dies, the property will automatically transfer to me, meaning that there'll be no probate. And kid would be right in thinking that. That is exactly what would happen. There is no probate on things that have joint tenancy because it doesn't go into their estate in the first place. It automatically transfers. And you have avoided paying $14,500. Were that it was so simple. Let's think this out for a minute. As it turns out, mom, because she's living in this house, is in her primary residence. What does that mean? That means that mom, let's say she lives another 10 years. When she dies, yes, her property will be worth, say, $1.2 million, and thus she'll have to pay, say, $20,000 in probate. That is true. But mom won't have to pay capital gains on that at all. It will be capital gains free. This is very different than child who doesn't live in that property and for whom this is not a primary residence. Now, if mom transfers to her child at the time that dad dies as a joint tenant, so gives 50% of the property to the child such that the child can then capture the property when mom dies without probate. There is no tax on that transfer because mom is transferring what is a capital gain-free transaction to daughter. But when mom dies, daughter's going to sell that house. It's just what's going to happen. And when that happens, there won't be probate. They'll save $20,000. But the value increase in that 50% of the property that child owns will then be subject to capital gains because they have acquired it 10 years ago. There's been 10 years of growth at the property. This isn't their primary residence because child is living with her husband and her child in their house. And thus, by transferring and trying to avoid probate fee of $20,000, what they have done is they have taken 50% of the property and made it subject to capital gains over 10 years, which will be vastly in excess of the $20,000 saved. Now, this isn't always the case. If mom is suffering from Alzheimer's and late-stage dementia, and we know that she's going to pass in the next 3 months, great, go ahead and do it because it's $20,000 savings, and there won't be that much accrued growth in the amount that kid takes on. But it's a case-by-case basis, and generally, if mom doesn't have an expiry date over her head, sorry to be crass, but this is the way we have to think about it, then it makes very little sense to transfer into from mom's name, given that avoiding probate comes at the expense of losing effectively your capital gains increase and exemption for the time that the transfer is in effect. Does that make sense? Does everyone understand that? So Jesse just wrote, if the property is a rental and goes up in value, upon mother's death, child becomes the sole owner. Mother's share capital gain, will that be taxed against mother's estate in her terminal tax return? I'm just going to read it one more time. Sorry, Jesse. If the property is a rental and goes up in value, upon mother's death, child becomes sole owner. Mother's share of capital gains is 50%. Will that be taxed against mother's estate on her terminal tax return? Well, there's one problem with your question, Jesse, because if mother's death takes place, we're talking about father having died. So mother is the sole person who now owns the rental property, right? Is that what we're saying?
Hey, Mark, can you hear me?
Yeah, I can hear you, Jesse. I'm sorry. I just want to understand your question a bit better.
Yes, we are still talking about the joint tenancy situation.
So what would happen is, if it's a rental property, it is not a primary residence. So when she switches into her child, if she were to take this property and give 50% to her child, think about the ramification. She would never do that, because at that point, the sale would be for imputed value. Even if it's for $0, it would be for imputed value. And suddenly mom, while she's alive, when she decided to transfer, would be subject to capital gains. Why would she do that? Why pay that capital gains early if mom is okay? Does that make sense? Because it's a rental property. This isn't a primary residence.
Yeah, it doesn't make sense. Just that we talk about the technical result. If it's a rental property, then mom has to pay tax at 2 steps. First step, when he adds the child on title, it's a deemed disposition. So
Correct.
he has to pay capital gain on fair market value. And on her death, the property goes into the child as a sole owner. However, just technically speaking, how would the mother's share of the capital gain be taxed?
Oh, I see. So there'd be 2 separate tax events. Let me just back up for a second and explain what your question is, just to be clear, because not everyone is able to read the question. So what we're saying is, let's say that we take our scenario of dad having died, transferred to mom. Mom now owns a rental property, 100% in her name. If mom transfers that rental property to her daughter as a joint tenant, so that both of them now own it equally, how does the capital gains on that get paid? That's effectively what you're asking. And the answer is, am I right, Jesse? Like, what is the taxes payable in that event? Am I correct?
Yeah, both on the transfer and upon mother's death.
Correct. So the first tax that would be payable would be the 50% at the imputed value at the time of transfer to the child. And then when mom died, there would be a deemed disposition on death of her remaining 50%, such that 100% of the property was subject to capital gains, though at different times.
Okay, so when mother died, her 50% will be billed into mother's final return. Is that
Correct.
true? Okay.
Correct. So there's no way to avoid capital gains. The only way you can avoid capital gains is if you're transferring to a spouse. But once the last of the spouse dies, conceptually, there are technical ways of doing it, but conceptually, everyone is going to pay capital gains on every asset at the time of death, after the time of the last spouse's death. That's the way it's going to work. Make sense? Okay, good stuff. All right, let's move on. I only have 10 more minutes, and we have 2 more taxes to address. Next tax is the NRST. And you'll see this lovely map that I have. This lovely map is showing all the areas where the NRST is applicable. The NRST is the 15% premium levied on non-residents of Canada for any purchase for less than 6 units. for residential units, less than 6 residential units. Now, let me talk about a couple of things. First of all, sometimes you acquire the property with more than one person. If even 1% of the property is owned by a non-resident, then the NRST applies on the entire price, 15%. So it's really critical, because it's a 15% tax, it's really critical that we actually understand the laws and understand what qualifies and what does not for the non-NRST tax. So everyone has to pay the tax. That's the way the legislation reads, unless you are exempt. And who's exempt? Well, the majority of us. Canadian citizens. So if you have a Canadian passport, you are exempt, period. Doesn't matter where you live in this world. You can be in Dubai, you can have been there for 10 years. If you have a passport, you're done. Anyone who's a permanent resident. Anyone who is operating under the Ontario Immigrant Nominee Program. That is to say, they have brought into this country through the registered provincial body that is been delegated by the federal government as taking in the people who will eventually become PRs. Any refugee, or any spouses for any of the above categories, provided, and this is the same definition of land transfer tax, provided that the property is being used for personal use. So if this is a place where someone intends to live and their spouse is there, then, and they are a Canadian citizen or a permanent resident, then they are exempt. They are good. So these are the people who are exempt, the vast majority of people who you deal with. There are also several other people who are not exempt, but who can claim it back with time. The first being someone who becomes a PR within 4 years. Now, this is critical. It's a bit sneaky to my mind. Someone who's become a PR is fairly busy, but you have to basically file within 90 days of becoming a PR. You have up to 4 years. So you're allowed to buy a property, pay your 15% after you become a PR. The moment you get your PR papers, you have 90 days to file back for your tax. If you miss that deadline, it's an absolute bar. You do not get back your 15%. Further, an international student who's enrolled full-time for at least 2 years at an improved institution. Improved institutions are done through regulation. There's a list of them. I can supply them. They're pretty easy, but almost every single accredited institution that gives you a tax receipt is pretty much an accredited institution, as long as it's full-time. Full-time is defined as a certain amount of hours. I forget what it is, 65 hours a week or something. I forget what it is, but it is a definition. And then last, a foreign national that has legally worked full-time under a valid work permit in Ontario for at least 1 year. So what is it that the government's trying to do? The government is actually trying to ensure that the people who are exempt from the 15% tax have an actual bona fide interest in this country. You don't need to be a citizen to have an interest. You could be a prospective citizen. You could be someone who has dedicated their life to working here, all of those, or you could be someone who's studying here, but under no circumstance can you be some random guy sitting in a princely mansion in Dubai, sitting there saying, I think Canada's a good place to invest, here I go. That's what it's designed to stop. And the 15% premium theoretically should have stopped that type of speculation. I don't know that it did, but we can talk about the politics of this a different day. The simple fact is this tax exists and must be accounted for. Some questions that I've seen in my practice is, what happens if someone is holding this for a prince in Dubai? Well, no, then the tax is payable. Is the NRST payable on top of land transfer tax? No, it's not. If you are a Canadian, if you're not a Canadian citizen for tax purposes, but you have an actual passport, no tax is payable. What if you're buying a mixed-use property? Well, that's allocated by MPAC, the percentage of mixed use and commercial and residential, and you only pay it on the residential portion because, again, the NRST is only paid on residential on properties that contain less than 6 residential units. Commercial has nothing to do with it. All right. Let me turn to NRST. Any questions before I go to the last tax that we're going to discuss today, the withholding tax? We're good? Okay. Let's deal with withholding tax. So your Form 100 would, this is part of your OREA forms that you've glossed over, and every time someone says, what does this mean? You said, don't worry, it's standard form, let's turn to Schedule A. But it doesn't mean that you don't need to understand what your ORAA form say. And what your ORAA form says is that it says the seller is representing and warranting that the seller is not on completion and non-resident of Canada for tax purposes. I don't know why we can't speak in English and just say that you are resident, but we say not a non-resident. This is a critical component. This has nothing to do with citizenship. We're talking about tax. Are you a resident of Canada for tax? So let's talk about this. What is withholding tax? Anytime a Canadian sells any property, it doesn't need to be taxable Canadian property, any property at all, the buyer of that property legally has an obligation to pay 25% of the purchase price to the government. Now, that's not what happens. We'll get into what happens in a second, but that's legally what the buyer's obligation is, not the seller. Why? Well, let's take the instance of land. Let's take our sheik in Dubai, who's purchased property, not a resident of Canada. The property is purchased for $100,000. The property is sold for $250,000. The gain is therefore $150,000. What would the capital gain on that be? Assuming there's no principal residence exemption or anything else, it would be $75,000, and the tax payable at the highest tax bracket is 54%, meaning that you owe $40,500 to the government. Let's take a foreign real estate sale. Exact same documents. So what happens with this $40,000? So actually, let me go back here. So $40,500 is owed to the government. But the guy's in Dubai. It's wired over to his bank account. He's never going to step foot in Canada again. The Canadian government doesn't have a tax treaty with Dubai. And they say, hey, give me your money. And what does the sheik from Dubai say? That's exactly what he says. He says, you're not getting the money. Go away. And because of that, and because the Canadian government doesn't have their hooks into them the way that the Canadian government has their hooks into all of us, the Canadian government has said, we need to ensure that we are going to get our $40,500 from the sheik in Dubai. We're going to do that by getting the buyer, we're going to put an onus on the buyer to actually ensure that we get paid. And so if you take a look at what happens, if the same scenario takes place and there's a gain of $150,000, the buyer, because this is a sheik from Dubai and they're not a resident of Canada, has given the government $62,500. That is to say, of the $250,000, they've given 25% of the price to the government. The tax actually owing, as we've discussed, is $40,500. And in this instance, the sheik from Dubai will not say to the Canadian government, go F. What they're going to say is, I'll file taxes, thank you very much. Because when I file taxes, you'll find out, the Canadian government, that I only owe $40,500, and you'll give me back a check for $22,000. So now I have every incentive to file tax. And that's the reason the withholding tax is 25%. Does that make sense, firstly, why it's there for 25% before I go on? By the way, it's 50% for commercial properties. Okay, but of course that doesn't happen. We are allowed to transfer 100% of the value of the property in the event that we obtain one of three things. Either the buyer can give 25% to the government, as we discussed. Not the buyer. Should have looked at this before. The seller can prepay to the tax owing, get a clearance certificate from the government, and provide same to the buyer. So what can happen is the seller can say, I know I have to pay $40,500 upon clearing this. I will, through my accountant, pay that amount to the government, and the government will give me a certificate stating I'm okay, and I'm going to give that to the buyer so that the buyer can remit the whole amount to me. Or the seller can provide the buyer with a statutory declaration stating that the seller is a resident of Canada for tax purposes. And if the buyer receives that, signed and sworn, then they can proceed with the deal. As a result, what we are asking for in our OREA form is the seller is representing and warranting, they're stating and promising that they are resident of Canada for tax purposes. One of the documents that the lawyers will do out at the lawyer's office is a document that basically says, I, Arab Sheikh from Dubai, hereby state and declare that I am a resident of Canada for tax purposes and you can rely on this. And then the buyer keeps that in their possession. And if the CRA comes around and says, hey, that guy was a sheikh from Dubai, why in the world did you give that money? The answer that we would have back is because we received a statutory declaration that we believed in good faith meant that he was a Canadian citizen and we had no further obligation to look into it. Now, don't get me wrong, you can't be willfully blind. You can't be stupid. But assuming that someone doesn't give you any other indication to suggest that they are not a resident of Canada, you are entitled to proceed on that basis. In fact, I've had instances where the CRA has come back to me and said, your client buyer was responsible for X amount of dollars, we're coming after them, and I've said, no, here's our statutory declaration, go away CRA, and they have in fact gone away. So, it is a tax, it has to be paid. Why do I, as a seller's agent, care about this? And more importantly, will I please stop talking about tax? The answer is yeah, this is the last slide, so yeah, I will absolutely stop talking about tax. You care because it can spoil your client's ability to close their deals, which means less sweet commission buckaroos for you. Why? Well, think about this. If there is an obligation to pay the government 25%, and if there is a mortgage on title for more than 75%, then there will not be enough money to pay the mortgage out if they have to take 25% and pay it to the government. Accordingly, particularly when you are dealing with non-residents, if your seller is a non-resident, immediately get them over to a lawyer, and instead of just saying, here's a file, because the lawyer won't really look at it until 3 or 4 days before, make sure you highlight that this person is a non-resident so that we can immediately deal with this scenario, because the last thing we want is a scenario where the buyer is forced to remit 25% over to the government, meaning that the mortgages can't be paid out, the whole deal will fall apart. So that's my little spiel on taxes. We've dealt with a lot today. It is now 11:30, so perfect timing. Does anyone have any questions for me based on what we've talked about? I know it was fast. I know there was a lot of information, but hopefully you guys have found this useful. Any questions at all? Okay. Well, guys, as always, I thank you very much. I'm going to stop sharing, and I am going to post this on our website so that other people can have the benefit of watching. As always, thank you sincerely for attending. If any of you have suggestions for future talks, please let me know. We have a couple of good ones that are scheduled. Our next one is going to be on Friday with a special invited guest, Brian Madigan, who I'm excited about. And we will chat, no doubt, later on. My very best, guys.
Mark, what time on Friday are we expecting?
I usually do it about 10. I forget what we had agreed to. Brian and I had set it on a time. I think it was 10 o'clock. Just give me 1 second. I'll tell you right now. We said for him, I'm just looking up our correspondence. 1 second. 10, yes. Friday at 10 is going to be our next one with Brian Madigan. It's going to be on deposits.
All right, yeah, because Cloud has a meeting at 11 to 12, so I wanted to make sure it doesn't coincide.
Well, again, we have to schedule for much greater than just Cloud here, but regardless, from 10 to 11 means that you can attend your 11 to 12, so we're good.
Okay, perfect.
All
Thank
right,
you.
guys, my best.